So let's dive straight into the 7 steps. I was asked to talk about how to ingrain this fourth industrial revolution into the business of insurance. The first step is to acknowledge the new reality. So I've phrased each one of these as a series of novelty items. The first new reality is that if you were running a business 10 years ago, it was mostly about grabbing market share. You figured out who's the market leader, you put a bullseye on their back, and you go after the target. Roughly the same sort of strategy, roughly the same sort of products, roughly the same set of clients, and you went after them trying to grab market share. That kind of linear extrapolation is no longer available. At least here in ASEAN, as we discussed in the previous panel, you have current penetration of insurance at such low levels that you do have still efficiency gains to be made and productivity gains to be made from traditional businesses using technology. So that is step number 1 about digitizing existing processes. But it's really step number 2, which is where a fundamental revamp of the entire value chain is being effected. We're having to look at the entire spectrum from product development to marketing to distributions to claims management and then back to product development, a very short feedback loop between the two of them at a fundamental level. The second factor is that there needs to be a new focus. A lot of the times we can do this, we cannot do that, depends very much on our internal organizational structures, on our internal processes. There hasn't really been a lot of pressure in putting the client at the center of design. But that's what we're having to do right now. It's about the customer journey, the customer experience, the customer environment. That should be at the center of the design process. We used to think in banking that when you put a phone app in front of a client, you're trying to improve the experience compared to going into a bank branch. That was the competition. But that's not the competition. The competition is other apps that the customer has on his or her phone. They're unrelated apps, but the customer expects the same look and feel, the same user experience. So in your industry, that's the equivalent of real-time insurance claims, motor insurance claims, using photos and videos. The third step is to acknowledge the new approach. Before you get personal about people's private data, there's just a lot more public data. Weather-related data, crop performance, anonymized groups and cohorts of data. These allow us to thin slice the insurance offering into smaller pieces. As was mentioned earlier, you could get on a flight, go on holiday, and just as you're about to take off, you can buy insurance for that particular trip. So the policy ends when your holiday ends. Micro-insurance in bite-sized pieces is now feasible, whereas they may not have been in the past. And then with private data, as long as there is appropriate consent and there is a right ethical framework, personal data allows us to go for extreme customization and also gamification so that good behavior can be rewarded with discounts. Number 4, new value. So data analytics is not just about extracting value by insurance companies. They should enable the creation of genuine new value to the insured so that it justifies the margins paid to the insurer. To that extent, it's about reducing and preventing risk during the life of the insurer's contract, as opposed to the old style of fire and forget after the policy is written. So, for example, the device in my car that's monitoring my driving behavior that the insurance company has put in can detect patterns and perhaps let me know that I have a habit of speeding into the roundabout, and maybe if I stop doing that, my risk would be lower. Or what you see in the fitness world. Not only will they tell you that these are the number of steps you need to walk in order to get this discount, but while I have you here, since you are into activities now, would you like subscription to this sports channel on TV? And by the way, are you satisfied with your gym membership? Because we have a really good deal with Virgin gyms and you can get a discount. Oh, you're wearing an Apple Watch to detect your movement. Well, here are some other smart devices that you can buy. And if you can sustain your good behavior for 12 months, you'll get a free subscription to Amazon Prime. So that's the ecosystem and the community that they have built. And when you have that ecosystem approach, pricing becomes a completely different model to what you would have if you are a single-line insurance provider. Number 5, new risks. So there is just new business that you can have from the fact that, like cybersecurity, many of our systems are now closely coupled into tight, complex Internet of Things, which open up new risk sources that will need to be insured. Number 6, new competition. We'll hear very quickly from the disruptors, the upstart, startup competitors from competition coming from perhaps unexpected sources. And many of them, if fintech is any guide, they are chomping at the bits. They're cherry-picking the profitable parts of large financial services groups, leaving the unprofitable parts with incumbents. And one way to react to that is to embrace them, to stay close to them. In the way that Aviva, was it last week, acquired a majority stake in Neos. Neos is a smart technology company in London that fits these detectors at home, so that if I'm at work and the tap is leaking at home, before the water overflows and floods everything, it tells me that that's what's happening. And that company has only been around for less than 3 years. But new competition is not coming just from these small startups. They're coming from very large players with their own marketplaces, such as the Amazons and the Alibabas and the Tencents of the world. Some of them started their journey into insurance as third-party distributors. Let me sell you products, they would have come to you and said, or as providers of cloud-based processing services. Let me sell you some of our processing software so that we can take care of your back office. And these are Trojan horses. Very soon, they apply for insurance licenses. And there is certainly a case that they can make that they have an informational advantage given the accumulation of data over time. And ecosystems are very much like a club. You have happy hour in the clubs, right? Before 10 o'clock, if you turn up, the drinks are cheaper because they want to get critical mass to come in. So there's a lot of free stuff that get thrown in, lost leaders. And in many of those ecosystems, insurance is just incidental. It might even be one of those free stuff that gets thrown in the happy hour. And so then for us, whose principal line item is insurance, that becomes a difficult thing to compete with. In your case, it's not just the Amazons and the Alibabas and the eBays, it's also potentially the car companies or the manufacturers of sensors who could argue that we have the data and therefore we have the competitive advantage. And then lastly, my 7th point is new organizational culture. This relates to people and skills. If you want to have a chief digital officer, who do you hire? The type of skills you need is important. I don't know if underwriting skills will experience what doctors apparently are experiencing, where if you're a senior doctor and part of your value add was your diagnostic intuition, you could look at a set of symptoms and be able to tell what was going on because of your years of experience. A junior doctor or a nurse apparently is now able to make similar or better diagnoses using tools that are available there right now. The second part of organizational culture is how do we engage with people so that it is a culture of innovation as opposed to hierarchical command and control. One thing that a fintech startup or an insurtech startup doesn't have is number of people in the organization. And if you believe that in this world of disruption, no individual has a monopoly of ideas, certainly the boss does not have a monopoly of ideas, you want to be able to crowdsource ideas from your people, then that store of ideas resides in the large organizations. But for many of them, they don't have the ways and means to tap onto that wisdom of the crowd. But if they can, that's a source of competitive advantage. And then thirdly, lastly, organizational culture is about the culture of execution. When you say we're going to do new things, disruptive things, from inside a large traditional organization, how would you do that? Do you separate it out, or do you do it inside of existing divisions and run the risk of it getting suffocated by the existing leaders of that business before it can flourish and develop its own wings? What sort of performance criteria are you going to use if all of a sudden you say that we are now going to be a customer satisfaction-based organization? Will you have a DHL-style tracker for every case, or a TripAdvisor-style rating mechanism for every interaction? So these are non-trivial things. Getting the right balance between old and new, the right sequencing, the right sponsorship within an organization is, I would argue, the single most important differentiator that differentiates, at the moment, one big firm from another big firm. One big firm that has been able to move across, another big firm that has not been able to move across that. But for now, these are the 7 things that I hope will give us a framework for us to have a discussion on this. Thank you very much. Thank you very much for your time. Appreciate it.
Thank you.